back to another episode of Web3 Deep Dive Podcast. I'm your host, Rachel Wolfson. Today, we are filming an in-person interview here in Dallas, Texas at an amazing podcast studio. Super excited to be here. And I will be speaking with Jake Claver. He is the managing director of Digital Ascension Group, which helps family offices learn about digital assets. And Jake is just so knowledgeable when it comes to all things digital assets. He's been in the industry for a very long time. He's helped family offices build wealth with digital assets. He has built his wealth with digital assets, and he knows a ton about XRP and Ripple. He's a community member there. He's a part of that community. And Jake knows so much about digital assets, so I'm just really excited for this interview and for you guys to listen to the whole thing to hear his insights on the industry. Okay, before getting started with the interview, I want to take the time to thank the sponsor behind this episode of Web3 Deep Dive Podcast, Kula DAO. Kula is sponsoring this episode, and we're just going to take a minute or two to hear a little bit about what Kula DAO is doing and how they're innovating in the sector. Kula is a decentralized impact investment firm that transforms overlooked assets into shared prosperity and thriving communities by reshaping how value and opportunity are recognized worldwide. Okay, the moment you all have been waiting for, we're going to get right to the interview with Jake. But before doing that, I want to remind you to like and subscribe, especially if you enjoy the content that you're seeing on the channel today. Want you guys to stay in touch and not miss anything. So be sure to smash that like button, hit subscribe so we can obviously stay in touch. And without further ado, let's get started with today's interview. Hey, Jake, how's it going?
Great. How are you doing?
Doing well, thank you. And thank you for joining Web3 Deep Dive Podcast today.
Absolutely. Thank you for having me.
Yeah, and we are here in beautiful, sunny Dallas, Texas, which I love.
Yep.
Yeah, and Jake, are you from Texas? I never know this.
I am, yeah. So Dallas, born and raised my whole life.
Cool. Okay, yes, me too.
There you go.
We've got that in common.
Yeah.
Cool. So Jake, before getting started, if you could tell our listeners a little bit about yourself, your background, what you do, and how you got involved in the digital asset sector.
Yeah, absolutely. So I've been in crypto or digital assets for about 5 years. And kind of a backstory. So I went to school for finance, worked a traditional job, corporate America. Industrial sales is what I was doing, scaled multiple locations for a Fortune 500 company, got acquired by another company to come help them build their business. And during that period of time, I was saving some money, trying to buy a new home for my wife and I. And that was about in 2020. And so I kind of stayed out of the stock market until that point. And when the market fell, I watched my dad miss out on an opportunity in 2008 where he could have really capitalized and put himself in a good position. So I said, if that ever happens again, I'm going in. And so I took all the money that I had on the sideline and the money that I had in my 401k from a previous employer, rolled it to a self-directed IRA, and I went all in. So Facebook, Amazon, Google, Tesla. I thought, okay, these are going to be okay. People are going to have confidence in these. They're going to come back. And I happened to be right. FANG stocks did really well and continue to do well. But when they got close back to their all-time high in June, July of 2020, I started to look at other opportunities and how to de-risk. And so when I was in school, they said, hey, you want to get into risk-off assets when the market's going to be volatile or you're going to see downward movement. And like I said, I'd stayed out of the stock market up until that point, aside from my 401k. They got matched. Like, if you're going to get free money, why not, right? So, but anyway, I started looking at de-risking, and I was looking at gold, watched a lot of stuff about, Peter Schiff and Mike Maloney, other people that are gold bugs. They really resonate with me as far as their Austrian economics and free market capitalism and all that. And so I was watching a debate between Peter Schiff and a Bitcoin guy. And I don't remember who the Bitcoin guy was at this point, but he explained Bitcoin as technology and software. And that's when it really clicked for me. My brother he turned $5,000 into almost $200,000 in 2017. And he didn't sell at the top. And so I felt vindicated. I was like, see, it's a Ponzi scheme. You'd never really had that money anyway, You know how everybody is. And so when I understood that it was technology and what it was going to be doing to revolutionize finance, that's when it really clicked for me, and that's when I dove in. And so I took all the money that I had made in the stock market and I rolled it all into crypto in the middle of 2020. And I don't think I'm smarter than anyone, but I timed it well. And I just diversified across things. I analyze crypto the same way I would companies. I look at the use case, their partnerships, who's behind them, how they're going to be used, and then I try to gauge, what the price might be off of actual numbers. And so I got into Cardano, XDC, Theta was another really good one. Quant was a little bit later. XRP, and that's where I'm at now. But diversified across, I think it was 12 different cryptos, but with all the money, and I went deep on them and rode those up. And I made some pretty good money in 20 and 21. I wish I would have taken more off the table, just like everybody else. But that's how it started.
So you started off with traditional stocks, putting everything all in,
Yep.
and then you took all of those earnings and put it into crypto?
That's
Wow.
correct.
Okay. And we're not just talking about Bitcoin. We're talking about
Right.
different assets that you mentioned, like XRP and
Cardano, yeah,
Okay.
VeChain. There was a bunch of them that I thought, okay, like here's a use case. And Cardano, I still don't know exactly what the use case is, but I like the technology. I like Charles Hoskinson. I think that it's going to be adopted for something. And so that's just how I placed those bets because it's speculative.
Right.
And it still is, even to this day. There's really not a ton of utility. Just put out a video recently on like the actual traction and specific tokenization of real world assets for some of these networks. But even to this point, a lot of it's driven by Bitcoin and price dynamics there, and the rest of the market kind of cascades behind it.
Right. Let's talk about Digital Ascension Group, and because you are the managing director there. So what is Digital Ascension Group, and what do you do there? Did you start it?
I did. I'm founder and owner.
Okay.
Yes, ma'am. Yeah.
And what do they do?
So after I did well in crypto, I started trying to find professionals that could help me. I'd gone to school for finance, so I knew I needed estate planners and tax attorneys and CPAs and accountants. And I don't know if you've ever met or talked to Rich Dad, Poor Dad, Robert Kiyosaki. But he talks about going into battle with your team in business. And so that's what I tried to curate around myself after I came into a little bit of money. And I found it very difficult to find good advisors that really understood digital assets at scale. People dealt and dabbled with Bitcoin here and there. So I'd called almost 100 firms across the U.S. And just called and vetted them and tried to whittle it down to who actually knew what they were talking about, because I spent all my time researching this stuff. And I whittled it down to the 15 people we work with now. And I set myself up. And so I got on Twitter in probably late 21. And I started talking about how I was mitigating taxes and setting up my estate and what I was doing. And people gave me the deer in the headlights look, like, how are you doing this with digital assets? And so I thought, okay, there's something here. And a few people were nice enough to make some introductions to some family offices. So I started consulting for them. And then over the last 3 years here, we've built this out into a multifamily office with all the different aspects, but specific to crypto. So we have CPAs, accountants, tax attorneys, estate planners, and we have one of two SEC registered RIAs that specifically deals and advises on digital assets in kind. So people bring us their crypto, we provide institutional grade custody, the ability to borrow against it, advisory services around that, and creative ways to be able to generate returns on those assets without the same counterparty risk you would have with DeFi or most exchanges.
Got it. Okay, this is really interesting. So for our listeners that may not know what a family office is, can you explain what a family office is and what the purpose and goal is behind that?
Absolutely. So family office is a newer acronym or name for this, but it's really been around for thousands of years. The Medici family early on was kind of the first people that did this, and then you had the Rockefellers, which really kind of institutionalized family office. And the idea behind that is you want your wealth to last more than just the 3 generations that you would get from how most things transpire. If you look at the Vanderbilts, Cornelius built the wealth And then the second generation maintained it. And by the third generation, everybody was entitled, and they actually ended up liquidating most of their estate and went bankrupt. And so the premise behind a family office is you constitute certain values, you put together a constitution, a North Star mission statement, defining principles for your family, and then you pass that on, right? And you put controls and safeguards in place so that people have access to capital when they need it under certain circumstances. And some people might find that controlling, but at the same time, you want to make sure that people are responsible. What's the verbiage they say? With great wealth comes great responsibility. Most family offices use their wealth in order to give back, create some type of impact. Normally, that's their North Star. So, a lot of ESG stuff, a lot of philanthropic focus, and that can be really good for tax advantages. We have people we work with on that side as well, specific to digital assets. But the premise of it is that you would like your wealth to continue to grow over generations instead of regress. And the idea is to look 100 years into the future and structure it in a way where you're going to be able to, for that to last as your family continues to grow and use it.
Got it. So Digital Ascension Group works with family offices, helping them with digital assets.
Yes, ma'am.
But also with fiat and traditional stocks, or just digital assets?
We're specifically digital assets
Okay.
right now. We have a very good understanding of other asset classes and alternatives, including real estate and private equity, fund of funds, hedge funds, private credit. But right now we are siloed in digital assets because that's where we provide the most value to our clients.
Got it. So why would you say digital assets are important for family offices to know about, especially now?
So it's going to completely change the way they operate. The settlement of money and money moving real time and being able to do transactions faster and cleaner and be able to trust counterparties is a big deal for family offices. Most of the time, they're a tight network of people. And people make introductions once they work with you for a while and they trust you, which I think is good. You need to be vetted before you're brought into the fold or introductions are made. But many cultures are that way too. But I think with the advent of blockchain, there'll be situations where you can trust the code to execute a transaction between you and a counterparty, and you don't necessarily have to trust the counterparty. There won't be a way that they can do anything malicious or any wrongdoings because everything's structured in a way where the transaction is going to execute based on parameters that you both outline, and if those don't execute, then the transaction doesn't take place. And I think that that's a big deal for international trade, a lot of countries doing business with one another. Obviously, we've got the tariffs going on with China right now. But I think if you could level the playing field with this technology and people trust that things are going to be fair and equitable in a transaction, and so the counterparty won't be allowed to be malicious because of the constraints around the transaction, I think that it could provide a much wider breadth of stuff that family offices will get access to also. I think it'll democratize access to things. And then liquidity is probably one of the biggest pieces for family offices. Most of the time we only see 15 to 20% of their portfolio allocated to private equity or long-term investments in that asset class. But if you were liquid after 3 months or a year and a day, depending on how the deal's structured, I think you would see a lot more capital put to work there, which is great for our economy because they're going to be investing in startups and other things that are going to cause GDP to grow, revolutionary technologies. And I think family offices are going to play a big role in that moving forward. They have $16 trillion currently that are managed by family offices globally, about 14,000 family offices today. And that number's grown exponentially. I think there was just 3,000 to 4,000 family offices before 2020. So people are starting to see that this is something that they want to put together for their family and adopting the concept. And I think that it's similar to digital assets. I think we're only in the second or third inning of family office.
So are you seeing a big need, like a lot of family offices, are they coming to you to learn about digital assets and hoping to leverage and hold and do all of that? Are you seeing a need from family offices for this?
It depends. If they're first generation or second generation, yes. They've made some money in digital assets, and that's where we're providing the most value at this time. Third, fourth, fifth generation family offices are more about wealth preservation. So they're looking to generate a modest return on their portfolio. If they are making allocations to anything risky, it's a very tiny piece of their net worth. And that's normally the conversation I have with somebody that's in that bucket that has some interest and wants some education. We just put on the event last night to help educate family offices about this topic and show them who the professionals are that they should be working with. But most family offices, again, are looking for just 8 to 12% returns, make sure that their wealth is being maintained and growing year over year and not getting eaten away by inflation like the majority of people. And so when you tell them 20% or 40% returns, they immediately turn off. They stop listening because, and rightly so, most of the time that is a Ponzi scheme. It's something that's nefarious. It's something that's outside the guise of what you could normally earn in a market. And it's most of the time it's not sustainable either. It's hard to maintain those types of returns over an extended period of time. That's why we've seen Buffett, he's kind of a legend. He's been able to maintain a 20% return year over year for the whole duration of his career, which is unbelievable. Nobody else has been able to do that, him and Charlie Munger. So anyway, when you state those things to family office, they become very skeptical very quickly. And the way I explain it is, look, these are asymmetric bets. If you are able to pick winners, even if you put 1% of your net worth in these digital assets, and maybe you're diversified, then if you had a 100x return, you potentially double your net worth on a 1% risk of your portfolio. And if you lose the 1%, it's not going to cost you the farm, right? So that's the normal conversation. Is it's a small allocation piece of their portfolio in strong opportunities in digital assets, and there's an opportunity there for them to have significant upside with very minimal risk.
Mm-hmm. Are you seeing now that the Trump administration is legitimizing digital assets, and we're seeing a lot of traction there, really good traction? Are you seeing more of a need for people to come in and want to work with you?
So we're on the Digital Chamber. We're working to propose rules for the SEC around RIAs that are managing digital assets, along with the SEC's regulation around what tokenized securities are and how they're handled by fiduciaries. I think we're still early, but we have seen a lot more interest as of late. We'd had a pretty good turnout last night at the event from family offices.
Digital Fusion Summit, Shout out there.
Yeah, appreciate you. Rachel was a moderator, did a very good job. Thank you for doing that for us. And so, I think we're turning the corner. This space has kind of had a negative connotation for the past 3 or 4 years here after FTX and Voyager and Celsius and everything that transpired in 2021 when it did have a lot of traction. And this is, again, cyclical. Crypto seems to be on 4-year cycles. We'll see if that continues into the future. But I think right now, since we've seen the adoption by institutions issuing the ETFs and those passing and going live last year in 24, and now we have all these other ETFs that have been proposed, and we have a change of the chair at the SEC, we're starting to see more people reach out and want to have conversations for sure.
Yeah, that makes sense. Let's shift gears a little bit. So, Jake, you are also a big, part of the community, XRP community and the Ripple community. And I think that's kind of how we got in touch, actually, because I was at the XRP Vegas event a few years ago. So how did you get involved with that community, and what are your thoughts on XRP?
Yeah, I have a lot of thoughts. So when I got on Twitter and started talking about digital assets and what I thought they could be and how to mitigate risk and set yourself up in your estate and mitigate taxes, I find that the majority of people invested in XRP and utility-driven assets tend to be a bit older. And that's not a good or bad thing. It's just the demographic that tends to gravitate toward this believes that banks and institutions are likely still going to be around. Whereas, if you're a bit younger, you're a bit more libertarian, and you're going to be more on the decentralized finance and wipe out the banks, and all this is going to go away. And so just from the topics of conversation that I was having, It tend to be a lot of people invested in, XRP, XLM, XDC, HBAR, things that augment and actually benefit institutions' ability to transact versus competing against them, which is the narrative for Ethereum and Bitcoin, right, or Solana also. And so just because of the topics that I'm discussing, it lended itself more toward that community. And also I have very high conviction on XRP in particular. It's the only thing that I've invested in for the past 3 years. I sat down and had dinner with some of our partners last year and explained to them how we were mitigating risk and structuring our hedge fund and all the strategies that we were going to put together. And then they asked me about my portfolio, and I said, yeah, I just buy XRP. And they were like, but you understand all these other things, and you articulate it well, and you're actually putting it together in a way to do all that, and yet you're still going to do that. And I'm like, I just have a really high conviction that that's the highest ROI of anything. And there's a lot of reasons for that we can get into if you'd like to.
Yeah, I mean, and the price of XRP right now it's way up, right? Isn't it? What is it?
From where it was, yeah. So last year, for the majority of the year, it traded between 30 cents and 50 cents. And Ripple does have an escrow, and they own half the supply, and it's a time release escrow, so they don't have access to it all the time. But they do liquidate some tokens every month at the beginning of the month to fund their business, and it maintains price stability. And so at the end of last year, when the ETFs started to be announced, that the spot ETFs were coming, we have 17 ETFs, or maybe 18 at this point, that are going to come to market or have been proposed, filed their S1 with the SEC to approve them. We have a levered XRP ETF, which is the first one that was approved just recently here. But when the spot ETFs come live, the investment banks that are issuing these will have to buy XRP to back the shares 1-to-1. Well, actually, it's not that ratio. So Bitcoin is fractional. They buy a small piece of Bitcoin, and that is what backs each share, whereas XRP is actually like 20, 30, 40, 50, 100 XRP is what they're using to back each one of the shares in these spot ETFs. So at the end of last year, I think they started accumulating that. We saw some institutional volume come in, and a lot of people may say, well, it spiked up and now it's been stable. Well, these institutions average into the market. They use TWAP or VWAP, which is a time-weighted volume average. So if you wanted to come into the market, not have a ton of slippage or loss, you say, hey, I'm going to move in with 50 million or 100 million, and I'm going to do that over a month or 2 months. And you use somebody that targets the dips and gets you the better than average price over that period of time, whether you're buying or selling. And it doesn't cause the volatility in the market that a lot of people are used to seeing for big buy orders when whale comes in, right? So that's how these institutions have continued to aggregate more XRP while maintaining the volume to hold the price where it is around $2, between $2 and $3.
Where it is now.
Yes.
Yeah, right. I mean, and that's great. It's way up from what it was.
Yeah, it was a nice, 4 or 5x.
Right.
In about a month's time back in November last year.
And do you think that, and when I spoke at XRP Vegas, and I think it was last year, I think. Mm-hmm. That's when Ripple was just announcing their stablecoin, RLUSD.
Yes, ma'am.
Right? So did you see an uptick in the price of XRP when is RLUSD actually being used right now?
So they're only issuing it on Ethereum.
Okay.
So we'll get into the weeds here a little bit for people.
Yeah, let's get into it.
So there's a side chain on the XRPL that's an EVM side chain, or Ethereum Virtual Machine.
Right.
So it's a component of the Ethereum network that is the smart contract piece that's coded in Python and Solidity, which is the most prevalently used language to create smart contracts at this point. Ethereum gained a lot of traction, and so that's just where the developers and liquidity went, and so most people understand those languages. So they developed a side chain that's EVM compatible. But it's not live yet. It's supposed to go live here in like the next 2 or 3 days.
Oh,
and
wow.
Then at that point, they will be able to mint and issue the stablecoins on something that's connected to settle through XRP. So up to this point, they've just been issuing it on Ethereum. And there have been some exchanges that have adopted that, but I don't think there's actually any tangible value that's been generated for XRP from RLUSD yet.
Got it. Because I'm assuming that once people start leveraging the stablecoin, and as you know, stablecoins are game changing for the digital
sure.
asset space. I use stable coins to pay people, and it's just the best thing ever. And I mean, it's easy. And so do you think that once people start leveraging RLUSD, the price of XRP is going to go up because there's going to be utility there?
Well, it could. And the way it could is there's an amendment that's going to be passed on the XRPL, and there's already been one that's passed. So there's AMMs, or automated market makers. And these exist on other chains. It's a very creative way that they've structured this on the XRPL that generates returns for the LP tokens that you get for participating in the pools. There's a gentleman here in Dallas that actually runs the largest AMM on the XRPL that was at our event last night.
Oh, interesting.
So, client of ours.
Was he wearing the XRP jacket?
He was not. He was not. He stood next to that guy for
Okay.
a while, and he pointed him out.
Yeah.
So that's one way that you could pair RLUSD with XRP in one of those AMMs, and they would trade against one another. You have a chance for impermanent loss in that pool if you're going to put your XRP on both sides of that. Now, there's another amendment that's been proposed by Ripple and is likely to come to fruition sometime between June and July, based on my conversation with David Schwartz last year at Consensus. And those are liquidity pools. And so then you could pair XRP with RLUSD in a liquidity pool, and they would trade against one another and be used, but that would lock up XRP. So the more XRP is locked up, the less supply is on the open market. And if you have a bunch of volume being settled for stablecoins, to your point, moving through XRP, then yeah, you should see a pretty substantial increase in the price. And I think you're going to get, I'll say it here on your podcast, Google, Amazon, Apple, McDonald's, Bank of America, JP Morgan. I think the majority of them are going to issue their stablecoin on the EVM sidechain of the XRPL, and that is going to cause supply shock and then also a ton of volume to be settled by the asset.
When do you think, I mean, I agree with you. I think we're going to start seeing institutions. Now, when you say that, do you mean these institutions are going to have their own stable coins that they put through the XRP ledger?
Well, and so this is, and I've had a lot of people ask this. They say, well, don't stablecoins just completely remove the need for XRP? It's a settlement token, right? If both parties are able to, or willing to accept a stablecoin that represents the US dollar, and they think in peer-to-peer transactions. Sure, yeah. If I pay you with Bank of America stablecoin and it's worth $1, are you going to take it? Probably. But these banks aren't. If Bank of America wants to hold their stablecoin and JP Morgan wants to hold their stablecoin, you need a DEX or an intermediary between those two to allow for that transfer, because they're not going to want to accept each other's stablecoin for payment. And so that's where you need an agnostic bridge asset like XRP to sit in between to settle those transactions. And if that'll only happen, there may be some very liquid pairs, but you're just recreating the same Nostro Vostro accounts that we have today. You're going to have to lock up or hold some counterparty's token in order to settle and then convert inside your infrastructure.
Right.
And that's the whole point we're trying to remove. So I get people's point on that, but I just wanted to point that out here, that you still need a DEX, a decentralized exchange, or some bridge between those two to allow for settlement and each counterparty to receive what they want on the other side of it.
Right, yeah. Stablecoins are a really interesting use case. I mean, just getting back to stablecoins. And it's interesting that you're saying that we're probably going to see institutions issuing their own stablecoins, because for a long time, and I still, it's like hard to imagine. I use USDC a lot. And so it's going to create this mass adoption of different stable coins. Like, what's going to happen to like USDC, and what's going to happen to these other stable coins that are being leveraged today if we have all of these different stable coins?
Well, that's a great question. Circle just launched their payment network the other day, which is a pretty big deal. They've got payment transmitter licenses globally. I don't think USDC is going to go anywhere. I think it's probably going to be one of the prominent tokens used. But you may receive perks or benefits or interest or things for holding certain stablecoins, right? So let's say you're a foodie and you love to eat at a restaurant. Like Gary Vee did this with his NFTs, right? You could eat at his restaurants in New York if you were holding his NFT. I think that you'll have some similar things with stablecoins. There'll be incentives for people or rewards for people that hold certain stablecoins. and that will allow them to, gain market share. I think that Starbucks probably does this. Any international company that needs to settle remittance between locations and pay people in whatever currency they're going to want for their employees, I think will probably have a stable coin, potentially backed by the U.S. dollar, and they'll have to have treasuries to do that. Tether, I think, is very interesting. A lot of people utilize USDT. It is, $235 billion in current volume or market cap. It's the most liquid stablecoin for digital assets right now. I think they could sanction Tether when the stablecoin regulations here in the U.S. pass. They've already removed themselves from the EU because of MiCA. They've said that they're not going to be compliant with the U.S. regulations as they sit today. They've moved offshore to El Salvador, and they're talking about issuing a separate stablecoin that could be used and regulated in the U.S. But if they did that and there was a gap in the market, I think that's a really good opportunity for other people issuing stablecoins to gain market share very quickly.
Yeah.
So I don't know if that's coordinated or not, but it's an interesting topic.
It is interesting. Jake, you have so many interesting insights, and I know that we're running low on time because you're obviously very busy. I wish that you weren't, because I wish we had at least another 30 minutes, but I'm going to be respectful to your time.
I appreciate that.
So any additional comments that you want our listeners to know about before we sign off?
Just great job for you putting this together and getting good people on the podcast. If you guys, if this is the first episode you listen to, please subscribe to Rachel's podcast.
Thank you.
We do have our own stuff, right? So I have a YouTube channel. I'm on all social media. We try to be omnipresent out there. My media team, Max Avery and his group, does a really good job of making me look good. I guess in closing thoughts, just look to educate yourself if you're looking to get into this space, or if you are a family office or a high net worth individual and you're skeptical of it. I would encourage you to rethink that. Reach out to professionals that do understand this space and in depth and have had success. Past success doesn't always indicate future success. There's definitely market constraints and conditions that change, especially with the global macroeconomic environment we're in today. But I think on the other side of a potential global credit event, a lot of these networks and protocols will be implemented at scale, and it's going to completely revolutionize multiple sectors in the economy. And if you start to understand the underlying technology, you don't have to pick winners in the token. You could be looking at companies looking to incorporate this technology. It's just very similar to the internet. It's going to disintermediate a bunch of people that are making money off frictions in transactions. Brokers, title companies, the stock market. There's a bunch of things, and we're having these conversations with the Digital Chamber. But I don't think institutions are going anywhere. I don't think they're going to be circumvented. I think they're going to adopt this technology, and that's what's really going to cause the price appreciation.
Definitely, right. And Jake, if our listeners want to follow you, you're very active on X.
Yes, ma'am.
What is your handle again?
Beyond_broke.
Got it. Is that a book you wrote, or
no, ma'am? Yeah, I just
course you teach.
We have a mastermind group.
Okay, got it.
Yes, ma'am. So, when my consulting, that was my moniker, and I worked with people to do M&A for a period of time, and we would scale their business and try to create MRR and look how we could implement tech in their business to get a higher multiple for them before they exited. And so 3 years ago, it's about 2 years ago now, we started the community as a mastermind group. I've been a part of other masterminds, and there's a lot of value in camaraderie and community, but the educational component I felt was kind of lacking. We actually have insurance for our group of people. You can get health insurance through the group, which is pretty cool. I've never seen that done in a group. But anyway, that's our group, is the Beyond Broke Mastermind, and my moniker on most social media platforms is Beyond Broke or Jake Claver.
Got it. And you're going to do the Digital Fusion Summit probably next year in Dallas again. I encourage all of our listeners to kind of figure out how they could be a part of that. One of my favorite events in my favorite city.
I love that. Yeah. Thank you so much for moderating for us, and thank you for having me on the show.
Yeah, thanks, Jake.
Yes,
See you
ma'am.
next time. Thank you. Special thanks to 4Labs Digital for producing Web3 Deep Dive podcast. I'd also like to thank the sponsors behind Web3 Deep Dive. You can click the links in the show notes to learn more about each of the Web3 initiatives from these sponsors. Finally, thanks to the listeners for tuning in. Please be sure to subscribe, like, and share.